Are these numbers that you were expecting?
Not really, actually. I think our expectation and the market expectation was that inflation would go up a little bit further up, maybe to 13% or so. And we were surprised by the outcome.
Let's take a look at these numbers year on year. February CPI number was 0.3% higher than January's number. I'm going to take a look at what it was like, you know, in the previous year. But just at 0.3% higher, not much more than it was in January, considering that we did have that issue of that petrol price reform coming into the fall.
Well, indeed, it seems that the impact of the partial fuel price deregulation has been very limited. In fact, even in the January CPI figures, you could see that transport inflation or utilities inflation month on month declined. It wasn't the case this time. Transport inflation increased 4.1% month on month, and utilities inflation went up 1.7% month on month. But yet, the overall impact on the CPI has actually been quite limited. We saw food inflation decline marginally to 12.9% year on year in February from 13.1% in January. I think the pickup this time was on the all items less farm produce side, where inflation went up to 13.5% from 12.7% in January. And even there, actually, month on month in this category, there was a decline to 1.5% from 3.5%. And even more interesting, actually, if you look at core inflation, all items less farm produce and energy, it went down to I think 12.7% from 14.3% last month, year on year, and it went down to 0.8% month on month from 4.5% month on month in January. So really the inflation dynamics have improved slightly, at least versus expectations.
Let's talk a little bit about that reform that almost came in when it came to those subsidies. It was said that, you know, if we hadn't seen that whole debacle happen, inflation could have come between 9 and 10%. Do you think that that's pretty accurate?
Yeah, I think inflation was on track to fall into single digits, but obviously, given the shock that we had in January, well, the shock being the move to a higher CPI index, this is obviously not going to happen, and we think that inflation will climb further in coming months, probably to 11.5%, well, 11.5% in March, which is not an increase, but then to 13% in the second quarter, and we'll probably peak at 14.5% in July, August, and after that, it would actually start declining. So there will be an increase, but not as bad as expected.
Samir,
in fact,
what do you think is going to fuel that increase?
Well, because the CPI moved to a higher base in January, I mean, just from a statistical standpoint, year-on-year figures are likely to be higher than last year, especially in July, August, because inflation was in single digits at that point in time in 2011.
So do you think, you know, next year, 2013, the central bank wanting to have that single-digit inflation number, do you think that that's realistic considering all the factors that are at play here?
No, I think we're not going to see any single-digit inflation figures in 2012. In 2013, it's not impossible because at the end of the day, the high base effects that we see today will serve in 2013, in early 2013. So it is possible that we see inflation below 10% in the first half of 2013. Obviously, it's a bit early to tell. But that said, inflation will start declining from September. So I think overall, yep.
Let's just talk about money supply. What is the picture looking like in Nigeria right now?
We've seen the monetary aggregates growing faster and faster. For example, private sector credit growth was at 39% year-on-year in February and 41% year-on-year in January. And even M2 has actually been quite resilient. But again, that is driven by a base effect. Now, let's remember that in early 2011, when AMCON acquired the NPLs from the banking system, those NPLs were removed from a private sector credit time series. So there was a sharp fall at that time, and because of this, we have an increase year on year in the first quarter of 2012. But that doesn't mean necessarily that the banks are lending more or qualitatively more, and access to credit is still quite limited in Nigeria.
Because one of the things that seems to be a problem is structural difficulties, and there has been comment that, you know, that's going to be quite difficult to be able to iron out, because you're not talking about something that could happen right now. It's probably going to be a long process to be able to iron out some of those structural difficulties.
Absolutely. I think, you know, the issue of private sector lending is not really a function of interest rates. In fact, when the MPR was at 6% in 2010, 2009, this didn't make the banks lend more. It's more about the risk profile of the economy, about the fact that the banks are still somewhat reluctant when it comes to retail lending, and that they still lend to tier 1 names, sometimes at preferential rates. So it's going to take a long time before we really see a turnaround in this space.
When you're looking at 2012, what are some of your concerns, some of your key concerns going forward in the inflationary outlook for Nigeria?
I think the biggest risk is always fiscal policy and exogenous factors. We've seen the government freeze recurrent expenditure, although we must say that capex spending is going to increase on paper, because in reality the level of execution has been quite low historically. So for now it doesn't seem that spending will be an issue when it comes to core inflation. In fact, as you can see, core inflation is falling. The second factor obviously is exogenous, because food accounts for 50.7% of the CPI basket. If you have a bad harvest, or if there is bad weather, for example, it can influence the CPI quite dramatically. But we haven't seen those signs materializing this year.
Okay, thank you so much for joining us. Samir Gadio is Emerging Market Strategist at Standard Bank.